It was a quiet day with the U.S. stock market closing lower by just 0.2% today, but it was a strange day where most stocks actually closed in the green, and it was really just the mega cap tech stocks that closed in the red to cause having a slight down day in the overall market. Remember, last week it was the opposite of that, where we had the mega cap tech stocks up and the rest of the market down for an up day. So you got to take the good with the bad in this business, but a little bit of a peculiar day to say the least. We did hear some news from the likes of McCormick, with their shares shooting higher and causing the consumer staples to actually stabilize quite nicely upon their earnings release here today. We also heard good news out of Alibaba, with that Chinese stock announcing that it's going to be breaking up into 6 different units. That actually caused the emerging markets category to outperform U.S. stocks here today, so we'll talk about that. We'll also talk about what all this means for our postures on the 4 major U.S. equity indices here in the U.S. Then we'll get into our trade application example today, where I wanted to focus on a large biotech company that's looking a little bit toppy here, and we're going to do a bear call spread. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 28th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. Also, remember at the bottom of those emails, you'll find which stocks are giving you overbought and oversold cluster signals within the S&P 500. In addition to that, we're heavy users of Twitter. If you're not doing so already, we would encourage you to follow us. My handle is @BrandonVanZ. We really appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the S&P 500 heat map pulled up here in front of us. And it was a mostly positive day, a little bit of an opposite day, as I mentioned on Twitter. For those of you that follow me there, I posted a screenshot of the heat map earlier this morning. It was even more obvious at that time, but what I was noticing was that the vast majority of stocks were in the green today, yet the stock market was down, which you'll recall was pretty much the exact opposite of one of the days last week I was with you. And the reason was for how I explained it to you then as well, which is, of course, the S&P 500 is a market cap weighted index. And last week we had at least one of those days. We had all the mega cap tech stocks in the green, with most of the market lower, but the stock market itself was still up. Today, we saw all of those mega cap tech stocks in the red, with the vast majority of other stocks in the green. So we did end up a little bit underwater in the market today, despite more stocks actually closing in the green. They were just the less important ones. So as you can see here, Microsoft was down about 0.5%, as was Apple. Visa was down about 0.5%. Alphabet was down about 1.5%. We got Meta down just over 1%. Amazon was down almost 1%. Some pretty interesting news on Amazon. Apparently, the rumor mill suggests that Amazon is interested in buying AMC theaters. Now, I don't know if that's legit or not, but that's what the trading community stumbled upon here earlier today. So AMC is not big enough to be in the S&P 500, so you're not going to see it show up here. But Amazon took a little bit of a tumble after that news emerged. I was joking on Twitter that they must have accidentally issued the press release a few days early because April Fool's Day is on Saturday. And that would have been a pretty comical joke, I think. Some of you might recall that many years ago, I think it was Taco Bell had this big newspaper display in the United States that said that they bought the Liberty Bell out in Philadelphia. Of course, that was just a joke. And so this kind of feels like it's in that vein. Like, really? Amazon buying a movie theater chain? Okay. Now, obviously, they do have their streaming video, so perhaps they do see an avenue to kind of work that into their business model. But it it was a little bit of an eye-opener. Well, let's just leave it at that. We also saw that Tesla was down over 1% here today. So those are kind of your big kahunas, right? And I should also mention NVIDIA was down about 0.5%. Those are your big kahunas in the market these days, and pretty much all of them were in the red. And that is why the market itself was down about 0.2% today, despite seeing all this green over here in these much smaller squares and rectangles. There were some pretty nice winners out there. Let's see what this one is. This is Carnival Cruises, a pretty small company these days, but it was up 6%. The biggest performer in the market in the S&P 500 today was McCormick. Some of you will know that that is a dividend aristocrat company. It's kind of been out of favor here over the last year or so, but boy, did it spice things up today. Of course, dominating the spice aisle in most grocery stores in the United States, at least there. So nice 9% move off of its earnings announcement here today. We also saw that Occidental Petroleum was up nicely here today, up about 4%. Upon the news that Warren Buffett continues to load up the boat with more Occidental shares. He now owns over 20% of that company. Pretty impressive haul that he's got there, in addition to his stake that he has in Chevron as well. One company that I should mention that you don't see listed here, but was very much in the green today, some of you saw me just tweeting about this a moment ago, was Alibaba. Alibaba is not listed here because it is not in the S&P 500, as it is a company, of course, that is technically based in the Caribbean somewhere, but is actually a Chinese company. It just so happens that that's the way that their corporate structure was. But anyway, they were in the news today for splitting up their company, or at least they intend to split up their company into 6 different companies. And Alibaba, along with a lot of Chinese companies, have been decimated in recent years. And today was a rare day where they were off to the races to the upside. So Alibaba up 14% today, and because of their market cap, that was an increase in their market cap of $30 billion. Remember, once upon a time, a lot of people felt like Alibaba was basically a cousin or even a brother or a sister to Amazon. That's how hefty it once upon a time was. Since that time, Alibaba has shed a lot more dollars, but of course, Amazon has as well. They've both kind of shrunk here in recent years. But today, finally some good news coming to all of the beleaguered Alibaba shareholders out there. Perhaps even Charlie Munger has a smile on his face after that. Anyway, you can see that for the most part, we did have a lot of green out there in the industrials. We had plenty of green in the energy. It looks like maybe there was only one energy stock down today. That was Williams, but all the rest of them appear to be up. We had plenty of green in the utilities and even in the materials there. We had plenty of green in the consumer discretionary outside of Amazon and Tesla. And then we had actually a pretty decent amount of green in the financials today, which we haven't seen a lot of that lately either, given the banking crisis that we're all working our way through. So it seems like the right-hand side of the board was more in the green, the left-hand side of the board was more in the red, and I would also throw healthcare into that conversation. I already mentioned technology and communications, but healthcare kind of had a less desirable day there as well, where it looks like there was a little bit more red than green. So a little bit of a strange day. It was a quiet day on the surface with a very small end result for the market, but kind of interesting once you dig into the details underneath the hood, where we actually saw way more stocks up today than down. But those mega caps unfortunately weighed the whole thing down. Let's take a look at the specific breadth numbers now. And I've got the S&P 500 pulled up here under the Market Watch Visualize area of the Thinkorswim platform. And as you can see, there were 310 stocks out of the S&P 500 that closed higher today. So that was good for about 62% of the market closing in the green, with 38% closing in the red. Now, despite that breakdown, as you can see from the charts here, as I mentioned before, the S&P 500 actually closed lower today, despite 62% of the companies closing in the green, because those mega cap giants like Apple and Microsoft and others kind of weighed down the markets a lot more than those smaller companies did. It wasn't a huge give back today. It was actually a little bit worse. In fact, the last kind of half an hour or so, we had a little bit of a push into the close, much to my chagrin, because many of you know I do my trade application example for this video, in that final half an hour. And sometimes it benefits me, sometimes it doesn't. Today I did a bear call spread. We'll talk about it later in the video. But of course, watching the market rally for the last half an hour after I placed the trade wasn't exactly what I wanted to see for that trade's perspective. But for other trades, it probably worked out reasonably well. So if it wasn't for that final half of an hour, we probably would have been down about 0.5% on the day. Still not a huge meltdown or anything like that, but definitely on a little bit more of aggressive side. Whereas the end result here with only a 0.16% drop when it was all said and done was kind of a yawn. If I'm being honest. You can see, however, that despite the very small price movement in the end, it was enough to change the posture on the S&P 500 back to strongly bearish. You'll notice here that we had this reversion to the mean rally last week and the week before. Of course, the worst part of this drop right here was when was at the height of the banking crisis with the Silicon Valley Bank news. Then we spent a good amount of time kind of rallying back towards that falling 30-day moving average, and we've been bumping our head up against the underside of that falling moving average, and that continues to be the case here today. You can see here that despite having all of these candles here recently touching the moving average, not a single one of them closed above the moving average. We would know if it did because the moving average color would change, and as you can see here, it is red across the board. So while on an intraday basis, you clearly cut through the moving average on a couple of those cases, just couldn't quite close above it, and that continues to be the case here today. So it kind of feels like we've been meandering sideways here in the last week after having a pretty healthy bounce the week before that. So the momentum is wearing off just a little bit here, and that's being reflected in the market forecast posture setting that we use here. And remember, we're using the green line when you hear us talking about postures, unless we say otherwise. We're talking about the intermediate green line on the market forecast tool. And you can see here that it has rolled over just ever so slightly. If I right click and maximize this, you can see it a little bit better here when it's blown up, that green line is starting to slump over. Doesn't mean that it can't gather itself and head back higher, but right now it's starting to look a little bit toppy right there as we're meeting that resistance on the chart. So as it stands right now, we're back to bearish postures across the board on all four of these major market indices. Be aware that the NASDAQ would be considered weekly bearish, my apologies. Weekly bearish, whereas these other ones are strongly bearish. So all four of them bearish, but the NASDAQ is the best performing one of those bearish ones. And so it still is giving us, a glimmer of hope that we can find our way out of this mess that we've been part of for quite some time at this point. The NASDAQ, as you can see, is actually above its moving average. So that's another way to determine that it's been our leader here recently. Of course, not a surprise there, given the leadership of the technology area, which of course is a very major portion of the NASDAQ composite. Stocks like NVIDIA and Apple and Microsoft and those, with the exception of today, struggling a little bit, have been kind of this market's leader here. And so that's benefited the NASDAQ much more so than it's benefited these other three indices. There is impact on the S&P 500 as well, and a little bit in the Dow, but not into the Russell 2000 with those particular companies that I had mentioned there. So anyway, NASDAQ clearly our leader at this point. However, today was a rare day where they took a breather. They were down 0.45%. And that did make them the worst index here today, despite being the only one that remains above their 30-day moving average at this point. The Dow, by the way, was down 0.12% today, so a very small give back there for the Dow in the end, similar to the S&P 500. It was enough that we did see the background color of the chart change from light green to dark pink. And again, that's because the green line has rolled over and is under the 50th percentile. Right? When you look at the readings within these labels, it shows the S&P 500 at 43 and falling, and the Dow Jones is at 27 and falling, both of those under 50, and therefore the darker shade of pink shows up on the chart, letting us know that the selling and the bearishness is a little bit more significant or serious in that case, as opposed to the green line rolling over on the NASDAQ, but still being up here at 69 above 50. There, yes, a little bit of selling has taken place, but it hasn't been as aggressive as what you've seen in the other areas, so it's not as worrisome at this moment. With the Russell 2000, by the way, it was down today, but it was actually the best performer of these for today. It was only down 0.06%, so really a yawn there. That's about as flat as you can get. However, because the Russell 2000 has found itself in the sharpest part of the sell-off compared to the other three indices. And remember, a big reason behind that is because of the regional bank crisis, where you're going to find a lot more of those regional banks in the Russell 2000 than you're going to find in those other areas. So it is still kind of sloshing around at some of those bottom areas that it has been struggling with for really the last 2 weeks. So we haven't seen a sharp snapback rally out of it. It hasn't even been a medium rally like we've seen with the Dow and the S&P 500. You really haven't been able to get up and go at all with the Russell 2000. It is just really meandering sideways here. And so it is the one that is most likely to breach its low the quickest if we have any follow-through selling in the market here in the short term. And so it, of course, remains with a strongly bearish posture. You'll notice that its green line is actually in the low reversal zone below 20 on the market forecast technical indicator. So regardless of whether it was falling or rising, we would consider it to be strongly bearish. But in this case, it happens to be falling anyway, so it doesn't matter. But just goes to show you how out of favor the Russell 2000 has been, that its green line is all the way in the lower reversal zone, and that's the only one of these three charts that can make that claim. So 3 out of these 4 charts have strongly bearish postures according to the market forecast, and 3 out of these 4 charts are trading below their falling 30-day moving averages. And those 3 charts are the same in both of those instances: S&P 500, Dow Jones Industrial Average, Russell 2000, whereas there's a little bit more positivity out of the NASDAQ Composite as a result of strength in mega cap tech recently, and there you only have a weekly bearish posture, and here you actually have price above its moving average at this point. So who knows, maybe that could be used as support as opposed to the assumption that with these other indices that is more likely to be used as resistance in that case. So we'll keep our eye on that, and as things change moving forward, of course, we'll keep you up to date here in these market outlook videos. Let's go ahead and see what's going on now with our 3 green arrows status. And where are we? Here's 3 green arrows. This is the chart 4D for those of you following along at home. And at the moment, we actually don't have any of these 4 charts with either 3 green arrows or 3 red arrows. Yesterday, we would have had the NASDAQ still with 3 green arrows, but today you'll see 1 arrow snuck in there with the stochastics. I know that's kind of hard to see, so let me right click and maximize that a little bit better for you, but you can see by just the smallest of margins that stochastic fell below its upper reversal zone. Remember, the stochastic upper reversal zone is different than the market forecast. The stochastic is at 75, and so we ended today just a hair below that at 74.71. So it could easily get back into the upper reversal zone tomorrow and get that green arrow back. But for right now, it did do away with the 3 green arrow status that it would have had otherwise. And of course, these other charts are struggling with some of those arrows as well, where all three of them have a green arrow on the MACD histogram, but all three of them also have two red arrows with the moving average itself and then with the stochastic. So not a whole lot of decisive activity here out of these charts according to the way that we read it with that system. Let's also take a look here at our longer term charts. This is the 1040 crossover now. And this is chart 4C for those of you following along at home. And a reminder that these charts here are 3 years in length, with each one of the candles representing a week of time, right? Not a day like the other charts. And in this particular case, you can see that it is a clean sweep of bearishness from a longer term perspective. In other words, the orange moving averages that you see on the charts are trading below the blue moving averages on all four of these. And that was not the case the last time I reviewed these with you. We've had some changes in that regard here more recently. You can see that the Dow has gone to a death cross. It sounds ominous, I know, but here what we're using for establishing that is this orange line represents the 10-week moving average, and the blue line represents a 40-week moving average. And so for those of you that use daily candles, you might be using a 50-day moving average and a 200-day moving average. They're basically the same thing, right? Because, of course, there are 10 weeks for every 50 days approximately, depending on holidays and things like that. Of course, it could change a little bit, but in general, that kind of jives with that same mindset. So if you've ever heard people talking about a golden cross or a death cross, they might be referring to the 50 and 200-day moving averages. In this case, we're using the 10-week and 40-week moving averages, which approximately account for the same thing. Anyway, you will notice that it was just last week that the Dow slipped back into that death cross territory, and it was the week before that that the S&P 500 did. The NASDAQ, interestingly enough, despite being the strongest of these four right now in the shorter term, is the only one of these charts that did not flip to a green background color to see a golden cross take place during this entire move. And this stretches back basically an entire year at this point. The NASDAQ had its death cross back here in February of 2022. So we're talking about over a year at this point. It has been in death cross territory, but you do have to remind yourself that prior to that, notice this amazing run that the NASDAQ had from May of 2020 until February of 2022. So you had well more than a year of bullishness, followed by, at this point, a little bit more than a year of bearishness. But there is a decent chance, if Apple and Microsoft and Nvidia and those types of companies continue to gather steam, it's entirely possible we do see the NASDAQ go to a golden cross here sooner rather than later. You can see how close those two lines are. If I right click and maximize it, you can see that they're nearly touching right now. So theoretically, it could just be another couple of weeks before we see a cross take place there. On the other hand, if the market rolls over in a big way right now with a bunch of selling, then all bets are off. But right now, it's kind of looking like the NASDAQ wants to go for it, right? They're gathering up the strength and the momentum to try to achieve that. That is something that has been accomplished by these other three charts already. But unfortunately, the other three couldn't hold it. So maybe the NASDAQ, while being the laggard from that regard, will be the one that has the best chance of retaining that crossover for a longer period of time, because you can see it's been rather brief for these other ones. We can see that strip of green right there on the S&P 500 only lasted like 4 weeks. It lasted quite a bit longer on the Dow because it had a pretty good run into the end of 2022. So here you actually saw the green for probably about 3 months there, but the Russell 2000 in the lower right here, that only lasted for about a month and a half. So they really haven't had the oomph to put in these really extended stretches of bullishness like we were used to in prior years. Maybe, just maybe, the NASDAQ can give it the old college try for us. All right, let's go ahead, pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these market outlook presentations. And the last time I did the video on Thursday, you guys stepped up to the plate for me. I really appreciate that. 117 of you clicked like for me. And as I always say, as long as we're up and over 100 likes, then I'll plan on doing a full-length video, which includes the 12 grid analysis and trade application examples and all that kind of good stuff. On the other hand, if you think that these videos get a little bit too lengthy for your preference, then feel free not to click like. And if we're under 100 likes, then I'll just plan on doing a quick 15-minute version without a trade application example the next time around. So we'll let you guys decide collectively on that, but let's do some shout outs here. Thank you to Trunk and to Payu and to George and Brandon and Scott and Shagard. I think that might be Jesse Livermore's picture there, if I'm not mistaken. There's John. Thank you to Michael and to Roger and Jason and John and Ranhan, and we've got Prickly Trader, and we've got Jim and GDP and Ram and Word on the Tweet and Ken and Ashley, Valerie, Mike. We've got Julie and Anne. We've got Roger and Duncan and Sonia and Ayakipa. The list goes on and on and on. A lot of great folks out there helping us along. We appreciate each and every one of you. Sorry if I couldn't get to your name here today, but we just chew up too much time doing that. Nonetheless, fun to see your name in the stars every so often. So thank you once again for helping support David and I in this mission to spread our education to the widest amount of people as we can. All right, let's also have a little bit of a chat here about the sector selector. Many of you are already members of Market Scholars, but if you're not, feel free to inquire about our services where we use a variety of tools in our classes, and this sector selector tool is used in my Monday top-down trend trading class where we're looking for stocks that are exhibiting relative strength. But we're not satisfied when only the stock is doing well. We want that stock to belong to a strong sector and also to a strong industry group. So we use both this sector selector tool and the stock selector tool for that particular class. Anyway, this gets updated over the weekends, so it's a couple of days stale at this point when I'm with you here on a Tuesday night, but can still give us a pretty good lay of the land and give us an understanding of what's been taking place here more recently. And as you can see, information technology managed to keep itself up at the top of the heap here for the second week in a row. As mentioned before, this has been a market that has been identified as one being led by NVIDIA and Microsoft and Apple. And of course, those are the key stocks within information technology, as they were the prior week. So that's not really any new information. But speaking of new information, you can see that communication services has been surging here recently. Communication services is where you're going to find stocks like Alphabet, where you're going to find stocks like Meta and Netflix and, a lot of those internet-related companies. In the old days, those internet companies were part of technology, but then they had a huge shakeup in the global industry classification system a few years back, and they put a number of those internet giants into communications alongside the telecom companies. So anyway, you can see a pretty big move there week over week, where communication services was 7th in their ranking last week. Of course, the week before that, they were 8th, and the week before that, they were 9th. And some of you that have a good memory will recall that communication services was the sector that was the most out of favor, the most aggressively out of favor, the most consistently out of favor, however you want to say that, in 2022. So it seemed like when we looked at this together, communication services was down there dead last. Well, this year brings a new opportunity, and many of those names are starting to benefit from the rise in AI and the rise in technology, and all that kind of stuff kind of plays well for those internet-related names. There was also some positive news out of the gaming companies. Some of you might have heard that Microsoft is more likely to get the green light on buying out Activision. Those game companies like Activision and Take-Two and Electronic Arts, they're all communication services companies as well, just like the media companies like Disney and like those types of cable companies are. So it's kind of a hodgepodge there in communication services, but right now really being led higher by a number of those internet names, kind of just following suit from what we've seen with those tech stocks. So I think that's a good sign for the market, all else being equal. You also saw that discretionary made a move. It wasn't nearly as dramatic as communication services, but still going from 6 up to 5 week over week. That is, all else being equal, a strong sign for risk appetite, especially when you compare it to its cousins, consumer staples, right? You've got your consumer discretionary, which are the wants of the world, and consumer staples, which are the needs of the world. And usually what you find is that the consumer staples swing into favor when there's nervousness in the air, whereas the consumer discretionary starts to get a benefit when there is more of a risk appetite out there. So that's also a fairly positive sign that we have in this particular case. Notice that consumer staples weren't alone from the defensive category falling last week. We also found that utilities fell last week, as did real estate. So, all in all, that's pretty much what you want to see. The more cyclical and growth-oriented sectors showing an improvement. At the same time, you see the defensive sectors showing a deterioration. Of course, financials have their own story going on right now with the banking crisis, and they have remained dead last for 3 weeks in a row. Also, of course, we had a great day of classes here at Market Scholars. I taught my dividend growth investing class earlier today, where we had a very unique circumstance that I have never seen in the past. So how's that for a tease? For those of you that are premium members, I don't want to spoil the surprise, so feel free to watch the recording when you have the opportunity. And then David taught his directional option strategies class earlier today. So feel free to check that out when you get some time as well. Tomorrow morning, I'll be back in the saddle with factor-based swing trading. And as I mentioned last week, we had the rare opportunity to hit the easy button on one of our trades, where we got into a trade last Wednesday in class and we shut it down immediately on Thursday morning at max gain. And so always fun to get the stocks to go in the direction that you want. In that case, it was actually a short selling trade that went to max gain pretty much immediately for us. And we are very thankful for when that occurs, because we all know trading's not really that easy. So every so often you get some good luck heading in your direction. So let's see if we can do it again tomorrow morning, shall we, gang? All right, let's go ahead and pop back on over here to the charts, and let's go ahead and do some 12 grid analysis. So we're going to get started here with 5A, which is our asset class 12 grid. And as you can see, we've got quite the mix of green and pink charts here. A reminder that the background colors of these charts will tell you whether we have a bullish or bearish current posture. It does not change back and forth the way that the larger charts do, because it would scrunch up the data too much. So when you're looking at these 12 grids, the pink charts are telling us we currently have a bearish posture on those entities, and then the green charts are telling us that we currently have a bullish posture on those particular securities. Let's get started here in the lower corners, as we are wont to do. And let's start off with the 10-year U.S. Treasury yield. It has bounced higher for 2 days in a row. It ended today at 3.56%, which of course is still well under where many of the shorter-term Treasury rates are currently, closer to 4%. So we continue to be in an inverted yield curve territory right now, but it does seem like you're trying to get some stabilization here in yields all of a sudden. Of course, this banking crisis kind of threw a wrench into things where a lot of people were just simply looking at inflation and the economy and things like that to determine whether they thought we were going to see rising interest rates out of the Fed, but all of a sudden we've got this banking crisis in there, which might be doing part of its job for it. So it could very well end up being that the Fed stops raising interest rates a little bit sooner than it would have otherwise because of the pain that's taking place in the banking community right now. But for the last couple of days, we have seen a little bit of a snapback after pretty aggressive selling there ever since that banking crisis has emerged. Naturally, when interest rates are rising like they are today, we do have bond prices bouncing. At least the Treasury bonds were bouncing here today, up 0.18% on the long-term side of the coin. However, the foreign bonds and high-yield bonds were just on the underside of break-even today. They weren't big sell-off days, but they did close a little bit lower there today. You will notice that the TLT, which is the long-term U.S. Treasuries, remains above a rising 30-day moving average. And so that green color right there helps you deal with the fact that you have a light pink background, because you're kind of getting two different pieces of information there. The market forecast posture says that we have a weekly bearish posture, but the moving average is suggesting that the path of least resistance looks a little bit better than that. I think if we all look at this chart, we're probably seeing a chart that's chopping sideways without a whole lot of direction there either way, so it might be a bit of a moot point regardless. But anyway, we do have at least stabilization in the bond market, whereas in 2022, you will recall that bonds seem to be falling relentlessly week after week, month after month. Here in 2023, it's been a different story where there has been decent stabilization, and there's probably a little bit more opportunity in the bond market here now that interest rates have kind of reset to much more substantial levels here that we're dealing with. In the lower left-hand corner, you can see that the US dollar was down about 0.36% today. So it was a pretty decent sell-off there in the dollar. This was their second straight sell-off. And of course, they've been mired in a little bit more selling here in the last month or so. We did have a period of time where it was rising and it looked like it was going to be off to the races, but things fell apart, and we now all of a sudden find ourselves not just below the moving average, but below a falling moving average. And so, that's not necessarily, a good or bad thing. You can't really say that as a blanket statement. What I generally think about personally, because I'm a big dividend growth investor, and my focus on my stocks tends to be on multinational companies, many of them headquartered here in the United States, but doing a lot of business overseas. So my own personal preference is to have the dollar weaken. And so I don't necessarily mind this environment that we have right here, but obviously things can change in a hurry. So it's not like it's set in stone that all of a sudden the US dollar is going to keep on weakening. It's just looking a little bit uglier at the moment. Now keep in mind, sometimes when the dollar struggles like it has lately, gold can be favorable as a result to the upside. We talked about that a little bit when I was with you last on Thursday with that trade application example, and you can see that gold had a pretty nice day today. It was up 0.82%, and while we're not at the 3-month highs that we were at about a week ago, we are still up there in that upper echelon territory. And what I did like about GLD's chart is with this pullback that we kind of stabilized with yesterday, notice that we basically stabilized right across the tops of those prior resistance areas back here in late January and early February. And so this is kind of that concept of breakout retest. And that happens quite a bit. It's rare to find a stock that just breaks out and keeps on rocketing higher without any give back. So give backs are normal. We just don't want aggressive give backs. And if the give back only brings us back to where the breakout occurred, that makes us feel like there's still a pretty decent chance that this will remain bullish moving forward. Today was a pretty impressive response to that possibility, because remember, where it closed yesterday, it could have easily just kept on rolling over today, and then all bets are off. So this was a little bit more of a promising snapback rally that we had today in GLD. Gives us a little bit more hope that there's more gas in the tank for this move in future weeks and months. Oil's a little bit of a different story. You can see that oil was up today as well, not nearly as much as gold. It was only up 0.62%. But when I look at the chart of oil, I'm not nearly as impressed as I am with gold. Gold, you can see, has that green moving average, price above the rising moving average, whereas oil continues to struggle with a red moving average, price remaining below a falling moving average. All else being equal, there's a lot more heaviness to this chart right here that could result in selling at around these levels where we find ourselves right now on oil. So oil had a good day today in terms of oil stocks, as I mentioned before, with just one company closing in the red, and of course the Buffett news with Occidental helped a little bit there as well. But you got to tread a little bit more cautiously in that area, knowing that oil is struggling from the commodity side of the perspective here. And if we see this rolling over on the underside of that falling moving average in coming weeks, then you'd have to believe that there'll be a little bit of a give back in the oil stocks as well. So let's keep our eye on that possibility. Obviously, it's not a guarantee, but I'm just kind of thinking in advance on how this chart looks. I'd be a little bit nervous that oil is going to start struggling at around these levels. And if I'm wrong on that, I'll be happy to admit it, and we'll talk it through if and when that happens. But we'll likely find out sooner rather than later, because we are right there where I would assume some sellers will start to step in the oil market. You can see up here at the top that the foreign stocks had a good day compared to U.S. stocks. So the developed foreign stocks were up 0.04%, which is not very much, but we have to keep in mind the S&P 500 was down 0.2% today. But it's really the EEM that had the impressive day, up 1.43%. And you guessed it, that's probably having a lot to do with that Alibaba news that I had mentioned before. Remember, the emerging markets are where you're going to find Chinese stocks still at this point, which is a little bit surprising considering China represents the second largest economy on planet Earth, yet it is still considered an emerging nation for a variety of reasons that I won't get into here. Nonetheless, that is likely the reason we saw immense outperformance out of EEM, up well over 1% on a day when the S&P 500 was actually down. So Alibaba has a lot of sway amongst the emerging markets because it is one of the largest market cap companies in those particular countries that make up the emerging markets. Bitcoin was up a touch here today. Not a big move, kind of matching what we saw with the rest of the market, a bit of a yawn type of a day. But what I would say about Bitcoin is it's at least stabilizing after we heard some news about FTX once again. Remember, it seems like that's the story that just simply won't go away. I didn't catch the full story today. I just saw the headlines, but apparently, there's allegations of fraud and things like that happening with Sam Bankman-Fried once again. And so who knows if that, takes the sheen off what has been a really impressive rally in cryptocurrencies, particularly Bitcoin. And, it's probably good to see it kind of closing, flattish here today as opposed to just plunging, like you might have assumed would have been the case given the news. This remains a very strong chart on Bitcoin, strongly bullish posture according to the market forecast, well above a rising moving average, and has been one of the better performing asset classes of 2023. Let's now go ahead and take a look at what's going on with the sectors. This will be chart 5C for those of you following along at home. And you can see it's a little bit of a mixed bag out there. We do have probably a little bit more pink charts than green charts. Nonetheless, it's not like it's a clean sweep. You can see that communications, which is the sector that surged into second place on the sector selector we were talking about a moment ago, it is one of those green charts that is noteworthy. It has a dark green background color combined with a green moving average, usually a pretty bullish combo there. You'll also find that down below, consumer staples have started to giddy up and go. And we're happy about that in my factor-based swing trading class as well, because I mentioned that we got out of our short selling trade last week perfectly in less than a day. But the week prior to that, we actually did a swing trade on a very popular Dividend King that is a consumer staple, that is a well-regarded company. And we had noticed the stabilization in the staples in general, and that is playing into our favor here. We're still in that trade, and there's no guarantees it'll make its way to our max gain, but we are definitely in the driver's seat of that because we anticipated this move a little bit more so. Usually we react. On that one, we anticipated, and I'm glad to say that so far it has worked. Whether it continues to, anybody's guess. You can see that we did have kind of a long upper shadow on consumer staples today, so that's not necessarily the best of signs. Then again, we had one yesterday as well, and that didn't stop it from going up today on a day when the market itself was down. So, you know, it's no guarantees out there, but usually when you start seeing those long upper shadows there, it is a reflection that the sellers are willing to step in, and the bulls have to kind of pull in their horns a little bit there. So we'll see where that takes us, but I am a little bit more appeased with the price activity out of the consumer staples here recently. This was obviously a very difficult go of things here for much of the last 3 months on consumer staples, but the last 3 days have been encouraging, and it's giving me the impression that if we do get a rollover, which of course we will, all stocks and sectors roll over eventually, but it's giving you the hope that if consumer staples roll over, maybe they can stabilize at their moving average and then work upon that to make their way higher. So we'll keep our eye on that possibility, but it is noteworthy to see that they're the only other one that has the dark green chart at the moment. We do have 3 other charts that are light green, and that is materials, energy, and utilities. Remember, what that means is that they have weakly bullish postures, not strongly bullish postures, and those can disappear very, very quickly. So you don't want to get too comfortable with them if things change, but it's giving us a heads up that, hey, there is at least some buying activity here more recently. And you can see one thing that brings all 3 of those charts together along with the staples chart is they all have been up 3 days in a row, right? Not even tech and communications can say that. They've both been down 2 days in a row. But these other charts are starting to show a little bit more promise with the consistency. They haven't been massive percentage moves or anything, but the persistency and the consistency of the bullishness, you know, helps them in that regard, being up 3 days in a row. So anyway, those charts you can see still are below their moving averages, which is why I don't want to get too excited about them at the moment. I want to stay open-minded towards the possibility of things changing in that regard. But for right now, you know, they're kind of in the penalty box because they've largely burned investors here in the last few months. And so, you know, yes, you're getting a little bit of a rebound here, but until they start spending more time above the moving average, I'm going to be a little bit more hesitant towards those. Whereas with consumer staples, as I mentioned before, I'm a little bit more willing to give them the benefit of the doubt. Now, as I've mentioned before, my own personal largest sector is the consumer staples, so I hope that's not playing a role here. Sometimes maybe I'm wearing the rose-colored glasses because maybe, you know, subconsciously that's what I want for my own portfolios as a dividend growth investor. But I think if we're being honest with ourselves, recognizing that consumer staples is above that moving average, whereas those other 3 charts are not, gives us the sense that, you know, it's not just my opinion there. There is actual evidence to support that comment there as well. So anyway, the rest of the charts are all pink, but to various degrees. I would say that technology obviously deserves you know, the benefit of the doubt in this case. Yes, you've sold off for 2 days in a row, and now you have that weekly bearish posture, but I'm not going to overthink that at the moment. Obviously, this is the chart that is the furthest above its moving average. It's true, stocks and sectors can't go up every single day. That should not surprise any of you. So yes, you're giving a little bit of that back right now, but all in all, this is a chart that was literally just at 3-month highs 4 days ago. So you don't want to give up on it too early. If it starts breaking down below the moving average, then that's a different story. But for right now, I think I'd prefer to stay in the more bullish camp with technology until I see otherwise. And you know, the other charts do look a little bit more bearish. You know, healthcare, by the way, is starting to look a little bit more concerning at the moment. It was down 0.6% today. Now, remember, this is the market cap weighted healthcare. It's going to be a little bit different than the healthcare that I show you in the sector selector, which uses equal weighting with its process. So this would tell us that the larger healthcare companies are struggling a little bit more than the smaller healthcare companies that are out there. And that's actually a really good segue for our trade application example today, because we will be focusing on one of the larger companies in healthcare for our bearish trade example here in just a moment. So let's go ahead and bring up that chart. So let's just bring up our swing trading chart here. And I'm going to pull up ticker symbol BIIB. This is Biogen. This is a company that is a very important biotech company. They are very important in the Alzheimer's area of the medical field. And so that comes with both possible reward, but also comes with anguish at times, as that has been one disease that we just have not conquered yet and haven't even come close to conquering yet. So whoever can, figure that one out, there's a big monetary reward waiting for them. So who knows, maybe it will be Biogen in the end that does it. But for right now, we're not thinking down the road years and years. We're thinking about what is happening right here in real time and what can we try to trade in the short term. And the way that I look at this chart right now is I start to see a little bit of bearishness creeping in. Now, you'll recall earlier in the presentation that I mentioned that when I placed this trade with about a half an hour to go, the markets were more bearish, and then all of a sudden they rallied fairly strongly into the close. And that was also the case here with Biogen. When I actually placed the trade, it was sitting right on its moving average, and it looked like it was going to start breaking down below that moving average. But as you can see, we had a nice little rally at the end of the session, and we actually ended up forming a bit of a doji candle here to a degree where there's more indecision there. I don't think that necessarily works against me in this case, but I'm just pointing out that it did look more bearish when I actually placed the trade, and then looked less bearish by the time the closing bell rang. That's the way the cookie crumbles sometimes. You get lucky and it goes in the direction you wanted to for the last half an hour, and then sometimes it does the opposite like it did for me here today. Nonetheless, you can see that one of the reasons that I selected it as a bearish trade did hold true despite the little rally into the close. The background color of this chart turned pink. Yesterday it was blue. Now on this chart is what we use for some of my swing trading classes, and we emphasize the blue line on the market forecast as opposed to the green line like we do in our trend trading classes. Because a swing trade, of course, you're planning on being in trades for much less time. I usually tell my swing traders that we should expect to be in trades for about 3 weeks. Sometimes you get lucky, like we did last week, and we're able to shut it down in a day. But and there'll be other times where, by the way, it goes beyond 3 weeks. We'll hardly ever be in a trade for more than 3 months. Whereas with intermediate style trend trading, there will be regularly times when we are in trades for more than 3 months, right? So each style is a little bit different there, and each style has its own unique set of market indicators that could be useful in implementing those strategies. So with this particular chart, it is a swing trading chart where you're not planning on being in it for months and months and months. And in this case, you can see that the blue line fell out of the upper reversal zone here in the last 24 hours or so. Yesterday, you had a red candle. Despite having a new multi-week high, it closed lower. That's probably not a great sign. It's telling you that the stock is starting to run out of gas a little bit. And it looked like today was going to follow that up with what I would have identified as a close below the low of the high day. And that was the case before that last half-hour rally, which ruined it for me. Nonetheless, the trade is on, so we'll see how it goes, and maybe it'll work out just fine anyway. But it didn't end up closing below yesterday's low. That would have emphasized the bearishness even more. But we do still have that bearish posture on the near-term line itself. The other thing that I think is helpful in this regard is recognizing that this stock has obviously underperformed the market at large. You have the S&P 500 dotted gold line up above here, and you'll notice that ever since about right here, the end of January, when this was kind of an inline performer, we saw a separation where the S&P 500 retained its strength, probably because it has more tech stocks in it, whereas Biogen continued to kind of roll over to the downside alongside its defensive brethren and sisters there in the healthcare sector. Now, keep in mind, Biogen technically is a biotech company, which does come with a little bit more spiciness than, let's say, Big Pharma, but this is one of the giants of the biotech world, so it does tend to move a little bit more so with the pharmaceutical companies as opposed to, let's say, the $2 billion biotech company out there. So this one's kind of more in the line of like your Eli Lillys and your Johnson & Johnsons and your Mercks of the world, as opposed to your really tiny biotech companies that are out there. So you can clearly see there's been underperformance there, and that might incentivize you to do a bearish trade on something that is already proven to be out of favor. Now, what I ultimately did with this trade was I sold a bear call spread. Remember, all the details are available to our premium members in our Telegram channel. It's one of the benefits we give all of you premium members there. So that way you can be notified of the trade before the market closes and consider it for yourself. Of course, we can't make recommendations. It's not our role, but obviously you're welcome to consider them. And if you like the trade setups, then maybe some of you will pursue those. But the details are always listed there for those of you that are premium members. In this case, if my memory serves me correctly, I did the May 295 300 bear call spread, and what that means is I sold the 295s, which are way up here, and I bought the 300s, which are right here. And what happens when you do a bear call spread like that, it's a credit spread, so you receive money up front, and I received a little over a 30% return on risk. That's usually what we shoot for with these credit spreads, so a favorable amount of return to make the trade worth our while. And what I want to have happen with this trade, for those of you that are newer to selling bear call spreads, is I want the stock to stay below 295. In fact, I think I got filled at 120. So you could actually say this. You could say 295 plus $1.20 means that the true break even is 296.20. And if I were to try to get my mouse as close to that as possible, 296.20 is right around that vicinity. And you can see that that amount, our true break even on that, would be above the prior high. If you kind of direct your eyes to the left of my crosshairs there, you'll see a gray label above one of the taller candles over there to the left, and it says the high previously was 295.90. So in other words, in order for me to lose money on this trade, this stock will have to eclipse this prior high over here. Now remember, maybe they have some Alzheimer's data or something like that coming out where that is entirely a possibility, but otherwise some of you will look at this and say, that looks like it's a pretty long distance away for this stock to go in just the next month and a half. And so that's the bet that we're making, that it does not do that. And as long as it stays below my break-even point, then I am more likely to make money on this trade than not. On the other hand, if it does surge higher on Alzheimer's data or anything else, the reason I bought the 300 strike as part of this bear call spread is it offers an embedded hedge. If this stock were to go up to, let's say, $350 or $400 or something crazy like that, I'm not going to lose incrementally more money for each dollar that it goes above 300. I will lose money, but I have a defined risk in this trade, and that's why I have a long 300 call in there to offset the short 295 call that drives the credit of this trade. Okay, so that's what I had for you here today. Try to establish a few more bearish deltas in the portfolio, with healthcare kind of rolling over on the underside of its falling moving average, and this company somewhat following suit, not exactly perfectly, but still kind of giving you the impression that maybe it's a little toppy here. I thought this one would be an acceptable trade application for the day. So if you appreciated the walkthrough of that trade multiplication example, or enjoyed the presentation otherwise with the posture setting and all of the 12 grids and all that kind of thing, as I always say, if you want me to do it again, click like for me there on Twitter. As long as we're up and over 100 likes, I'll plan on doing another full-length video for you when I'm scheduled to do it again on Thursday. On the other hand, if you prefer the shorter videos and you only want me to do it for 15 minutes, then don't click like, and we can take a little bit of an easier pathway on Thursday if that's what you prefer. So we'll let you guys decide there collectively, but whatever it is that you decide, I appreciate you checking out tonight's video. I wish you all the best of success with your trades and your investments. Goodbye for now.